Welcome back to our CMA exam practice series. In this episode, we'll be exploring the key aspects of recognition, measurement, valuation, and disclosure. So, let's get started. Accounts receivable, also known as trade receivables, represents the money owed to a company by its customers for credit sales. It's important to note that accounts receivable are recorded using the accrual method of accounting, which ensures revenue recognition is aligned with the provision of goods or services. When it comes to reporting accounts receivable, they are typically classified as current or non-current assets. Most of the company's accounts receivable fall under the current assets category, as they are expected to be collected within 1 year or the entity's normal operating cycle. Current accounts receivable are reported at net realizable value, which is the net amount expected to be collected. There are two key considerations for accounts receivable: estimating the allowance for credit loss and the estimation of the sales return allowance. The credit loss allowance represents an amount reserved for potential uncollectible accounts and is recorded as an expense. It ensures that bad debts are accounted for and matched with the related revenue. The direct write-off method, which expenses bad debts only when they are determined to be uncollectible, is not acceptable under GAAP. The allowance method, however, uses two approaches to calculate the allowance for credit loss: the income statement approach and the balance sheet approach. Under the income statement approach, the entity estimates the periodic credit loss expense as a percentage of sales on credit. This allows for a matching of credit loss expense with related revenue. On the other hand, the balance sheet approach determines the ending balance of the allowance as a percentage of the ending balance of accounts receivable. Another key consideration is the allowance for sales returns, which is established when merchandise can be returned. It ensures that revenue and related expenses are recognized in the same accounting period, providing accurate financial reporting. Another concept to master is factoring receivables. Factoring involves transferring receivables to a third party, known as a factor, who assumes the responsibility of collection. This can be done with or without recourse, depending on whether the transferor retains any risk or obligation to repurchase the receivables. Factoring can offer benefits such as prompt cash receipt, elimination of bad debts, and cost reductions. However, it's important to consider the associated fees charged by the factor. Inventory is the tangible personal property held for sale, work in progress, or materials used in production. It's classified as a current asset and includes goods purchased for resale or used in manufacturing. To measure inventory, we use the cost basis, which includes all costs incurred in acquiring and preparing the inventories for use. This involves factors like purchase price, taxes, handling, and transportation costs. For purchased inventories, the cost includes the purchase price, import duties, unrecoverable taxes, handling, insurance, and transportation costs. Net purchases are calculated by deducting returns, allowances, and purchase discounts from purchases and adding freight in. For manufactured inventories, it encompasses direct materials and conversion costs. There are two primary inventory accounting systems: perpetual and periodic. Perpetual systems provide real-time inventory updates after each purchase or sale, while periodic systems update inventory and cost of goods sold at specific intervals. Perpetual systems are suitable for expensive or unique items, while periodic systems are simpler and used for inexpensive and homogeneous items. Perpetual inventory systems update inventory accounts immediately after each purchase or sale, providing real-time information about inventory levels and cost of goods sold. It allows businesses to have accurate and up-to-date control over their inventory, facilitating decision-making and financial reporting. While periodic inventory systems update inventory and cost of goods sold periodically based on physical counts. They don't track inventory in real time, but rely on occasional counts to determine inventory levels and calculate the cost of goods sold. Annual physical counts are crucial for both inventory systems to detect misstatements and theft. Any discrepancies between the physical count and book inventory are recognized in the cost of goods sold account or as a separate line item in the income statement. Goods in transit and goods out on consignment are important considerations when counting physical inventory. Goods in transit include items that have been shipped but have not yet arrived at the buyer's location. If the shipping terms are FOB shipping point, the buyer includes these goods in their inventory. On the other hand, if the shipping terms are FOB destination, the seller includes the goods in their inventory until they reach the buyer. Goods out on consignment refer to inventory held by a consignee for selling on behalf of the owner, known as the consignor. The consignor retains ownership of the goods until they are sold. These consigned goods are not included in the consignee's inventory but are still the consignor's property. Remember, when conducting a physical inventory count, be mindful of goods in transit and goods out on consignment, as they impact the accurate assessment of inventory levels. When an exact count isn't feasible, inventory estimation is used. The gross profit method, utilizing the gross profit margin, helps estimate the inventory value even in cases of theft or destruction. Inventory errors can have a significant impact on financial statements, affecting current assets, working capital, cost of goods sold, net income, and equity. Timing errors can lead to understating or overstating these figures, while recording transactions in the wrong period may reverse in subsequent periods. There are several methods used to value inventory. Specific identification method, suitable for unique items, but requires individual tracking. Average method, calculates average cost incurred, either continuously or at the end of the period. First in, first out method, assumes the earliest goods purchased are the first sold. Last in, first out method, assumes the newest items are sold first. Retail inventory method is commonly used by retailers to estimate the value of inventory. It is based on the relationship between the cost of goods and the selling price. By applying a cost-to-retail ratio, the cost of goods sold and ending inventory can be estimated. When it comes to measuring inventory after initial recognition, the cost method plays a crucial role. There are two main scenarios to consider. First, in the LIFO or retail inventory method, inventory is valued at the lower of cost or market price. If inventory market price is less than its cost, a write-down to market is required, and it is recognized as a loss on write-down in the income statement. Alternatively, for inventory accounted for using other cost methods, inventory is measured at the lower of its cost or net realizable value. NRV is calculated as the estimated selling price minus the predictable costs of completion, disposal, and transportation. If the cost exceeds NRV, a loss on write-down is recognized in the income statement. Losses from inventory write-downs are typically included in the cost of goods sold. However, if the loss is significant, it should be presented separately in the current period income statement. Lastly, reversals of write-downs recognized in annual financial statements are prohibited. Once inventory is written down below its original cost, the reduced amount becomes the new cost basis and cannot be reversed to its previous value in future periods. This rule ensures consistency and accuracy in financial reporting. Thank you for watching. I hope you find the information helpful. If you're looking for more CMA exam preparation content, check out my other videos. Make sure to subscribe to my channel and hit the notification bell to stay updated with the latest videos. Thank you again for watching, and I'll see you in the next video.